Hello, I'm Mark Abssy, Head of Indexing at Tematica Research, and welcome to the week ahead. Now, as we usually do, we'll take a quick look at what happened this past week and then look forward to what we're paying attention to coming up. So this past week, overall, not a bad week. Broad indexes were up on general, on average, about 1%. Small caps, of course, doubled that at about 2%. We saw gold continue to rise, crossing 2,700. Volatility came down about 10%. Right? Started the week around 20, ended up around 18. So generally, we saw kind of a calming, at least by the end of the week, in the markets. Now, during the week, of course, we had some gyrations in tech with the ASML kind of early release. Not only was the early release not expected, but of course, what was released wasn't necessarily the best news. Good news there, of course, is that Taiwan Semi came out pretty much the next day and said, no, it's okay. We're doing okay, so don't worry about it. And markets went right back on their track. Of course, financials came out, JP Morgan, etc. Again, some good earnings. It put people at ease. In fact, when we look at sectors, the two sectors that kind of stood out to me were one, utilities, which led the pack this week, up about 3.4%, and energy, which fell about 2.6%. Now, why I call those two out for different reasons, of course. Energy is kind of like, yes, they went down, but for good reasons, which is to say that a lot of the unrest, a lot of the fears of all-out war in the Middle East have somewhat tempered or been tempered over the last week. And so, we saw oil start the week around 75 handle, closed on Friday at 69. So, yes, that may play into oil company earnings, but at the same time, it gives us a break. It helps on the inflation front. And of course, anytime we can kind of have any kind of calming effect in a very tense situation geopolitically, that's always welcome. Now, the other thing, of course, is utilities. We talked about that a little. Well, we've been writing about it anyway, but basically, what's happening is that nuclear power is starting to kind of have its moment. And it's not coming from the folks who you thought it would, right? There's been kind of a growing sense of, hey, well, nuclear energy is kind of green, despite what people may think and say about the waste product from it. But basically, tech is kind of leading the way here, right? A couple of weeks ago, we saw Microsoft and Constellation Energy come out with a deal. This past week, we saw that Alphabet is not going with kind of a monolithic approach to power generation, but they said we are going to invest in small form factor reactors. And that basically, in as much as everyone liked the Microsoft Constellation Energy deal, the Alphabet announcement sent everybody crazy, right? The Tematica Select Nuclear Energy and Uranium model was up just under 27% this past week alone, mostly on that news. And when we look at the top gainers across the entire stable of holdings that power our model suite, in the top 10, 8 of those spots were taken up by names in our nuke portfolio, which is to say all of the names in the nuke portfolio were within that top 10. From a economic data perspective, honestly, we got a housing update, we got employment update. Nothing really stood out, nothing really jumped out, right? We did see some gyrations over the last couple of weeks in some of the employment figures. That seems to have settled out. Retail sales, we saw a slight upside surprise, which is, of course, welcome and points to, a continually kind of strong, if you wish, consumer. Okay, so that's pretty much the week. Little bit of gyration, little couple tense moments there. The only other thing, I guess, that I that I didn't mention, China and its stimulus packages. We've seen news of the Chinese government introducing large, vast amounts of stimulus into their markets. We saw a big hit in that about a week or so ago. The effectiveness of that has kind of varied, or at least the interpretation of what that effectiveness is has kind of varied. So we're definitely keeping an eye on that. Of course, China and Europe have been engaging in a little kind of economic saber rattling here and there. Seems like the last round of talks that they had ended somewhat amicably. So we'll see what happens there. Okay, so looking ahead to the next week. Again, we had earnings this past week. Generally pretty good. Like I said, banks were doing okay there. And when we look at earnings for next week, there's lots of companies, and there's a good mix of companies as well, right? If I try and group them into categories, we're gonna see some more out of energy and utilities. Tesla goes on Wednesday. I think Verizon on Tuesday. There are some other financials that are coming out. We have some railroads, CN, Canadian National, on Tuesday, Union Pacific on Thursday. So we definitely will be looking for the comments, the notes. What are these guys saying? Not only about how their business is going, but what do they see going forward, and certainly for 2025, especially from rail, especially from some of the industrials that are going to be reporting. We're also going to have some retail as well. Skechers is going on Thursday. Newell Brands, and there, like I said, there's a bunch that is coming out this week, so we are going to be paying attention to those. Next week, in terms of economic data, it's actually pretty light. So we're basically going to get housing and employment updates on Thursday again, and that'll pretty much be it. When we look at the broader picture of kind of what to expect and what we're looking at, kind of the overall environment, the Atlanta Fed came out, latest Q3 GDP estimate of 3.4%. So that is certainly healthy. Doesn't point to the Fed needing to do any aggressive or super aggressive moves going forward. And to that end, when we look at the Fed futures curve, that's priced in. They basically priced in 25 bips for the November meeting. That's at about a 93% probability. And in the December meeting, it's kind of an 80-20 split as to whether or not the Fed is expected to raise another 25 bips or keep rates as they are. I expect that, depending on the outcome of the election, those odds are going to change pretty quick. I know the last time, or at least in 2016, when Trump won, markets reacted positively. In fact, they got a big bump. Now, in this election, Trump winning, I think we're going to see kind of a knee-jerk reaction of that again. But, and the big difference here is that, frankly, his rhetoric on tariffs, sounds good, sounds strong. But, I mean, if he really is talking about laying a 60% tariff on, quote, all Chinese goods, I mean, that's going to be disastrous for the inflation picture. There's just no question about it, right? And so honestly, in terms of inflation, whether it's Trump with massive tariffs, or whether it's Harris with, hey, let's break out the checkbook, frankly, neither scenario bode well for inflation. The only one that might get the nod is the Harris, let's break out the checkbook, because the effects would not be as immediate as slapping huge tariffs on everything. Not necessarily political advice, but just from a purely economics perspective, that's what you're looking for. Still, in line with the GDP estimate of a 3.4%. From our friends at FactSet, this has been a pretty good earnings season so far, right? 76% of S&P companies have beat estimates, right? And that is actually a better number, a better percentage number than both the 5 and the 10-year average for that figure. This Q3 is a fifth consecutive quarter of growth in earnings, about 3.4%. So that is a positive. And the only thing that it's not alarming, but it is something to take note of, which is, and frankly, given where valuations are, it's not totally unexpected. But the forward PE of the S&P 500 currently sits at just under 22. The 10-year average on that is 18.1. So we still are seeing some kind of stretch valuations, but at the same time, what are you going to do? The S&P is sitting at all-time highs. The ETF that tracks the S&P 500, right, the ticker SPY, recently crossed $600 billion in AUM, largely due to not only the all-time highs of the index, but also people seeing those all-time highs and kind of chasing. So, I'm not saying that's going to end, badly or poorly or anything, but valuations are something to pay attention to. I'm just trying to think. There was a note that came out on Friday. Goldman mentioned that it's actually pulling down its earnings forecast for Europe, which, if you follow this space, it kind of makes sense. They have been saying that, we're going to be under our 2% inflation target shortly, and they've actually, started to cut rates there as well. At the end of the day, though, it's just the U.S. markets are just they're not stopping. And if you are an investor, focused on alpha and focused on returns, honestly, the U.S. is looking like the market to be. So, in any event, that's pretty much it. Like I said, not a lot of economic data this coming week. We're going to rely on taking cues from those companies that are issuing earnings, and that's it. So, thanks for joining, and we'll see you next time.